For 15 years, the value of your portfolio, your home, and your retirement account has been built on a single foundation: cheap money. That foundation is now gone. For good. The story that matters isn't in the daily headlines. It's not about temporary inflation or new market highs. We've been conditioned to expect either a roaring bull market or a sudden 2008-style crash. But the biggest risk today isn't a crash. It's a quiet, fundamental repricing of every asset you own. The warning isn't coming from stocks. It's coming from the bond market. And it's signaling that the assumptions driving your net worth are obsolete. This isn't a temporary storm. It's a permanent climate change for capital. We are now in the early stages of the everything repricing, a deep reevaluation of what every stock, bond, and property is actually worth. Almost no one is prepared for this. Right now, a dangerous calm has settled over the markets. With inflation off its peak and the Federal Reserve pausing its rate hikes, the consensus is that relief is here. The yield curve is no longer inverted. It slopes upward, just as it should in a healthy economy. It feels like the bullet was dodged. This is a dangerous illusion. The smart money is no longer focused on the slope of the yield curve. It's focused on the level. For over a decade, money was essentially free. The Fed's policy rate was near zero. A 10-year Treasury yield of 2% was the norm. Today, the market is grappling with a new reality. A Fed funds rate expected to settle not at zero, but closer to 3.5%. The 10-year Treasury, the bedrock of global finance, now offers a yield over 4%. This is a seismic shift. We have moved from a free money world to a world where capital has a real, significant cost. The warning isn't the scream of a crash. It's the quiet, unnerving creak of a foundation buckling under a weight it was never meant to hold. Every asset was priced for a world that no longer exists. This is the repricing, and the market is only just beginning to wake up. This repricing isn't a theory. The forces driving it are building pressure that many continue to ignore. There are three critical points of failure. First, deep complacency in the credit markets. This is where tremors are usually felt first. The spread is the extra yield investors demand to own risky corporate debt instead of a safe U.S. Treasury bond. It is the market's true fear gauge. Right now, in February 2026, the spread on the U.S. High Yield Index is near a tight 3.1%. Far below the long-term historical average of over 5%. This isn't a sign of health, it's a dangerous mispricing of risk. The market is behaving as if a bailout is guaranteed, but with persistent inflation, that cavalry isn't coming. This is a profound miscalculation. The second crack is the great corporate refinancing wall. This isn't a future problem, it is a 2026 problem. According to S&P Global, nearly $3 trillion of corporate debt is maturing globally this year. Much of this was issued between 2020 and 2022 when borrowing was cheap. That debt is now coming due. A company that borrowed at 2% may now have to refinance at 5.5% or higher, a 175% jump in interest expense. That money comes directly out of earnings, innovation, and jobs. This is the slow bleed that will expose zombie companies that only survived on free money, triggering a wave of defaults the market is not pricing in. Let that sink in. The third and most important crack is the one that guarantees this is a permanent regime change: the government itself. For 15 years, the Federal Reserve was the biggest buyer of U.S. debt, keeping rates artificially low. That era is over. The Fed is shrinking its balance sheet. At the same time, the U.S. government must refinance a staggering $9 trillion of its own debt this year alone. This is where the math breaks down. Someone must absorb trillions in government bonds, but the largest, most price-insensitive buyer has left the building. Who will buy this debt? Pension funds, foreign investors, and individuals. Unlike the Fed, all of them demand a yield that compensates for inflation and risk. This creates permanent upward pressure on the cost of money for everyone, as the U.S. Treasury now directly competes for capital with every other investment in the world. So how do you navigate this? The answer is not to sell everything. It is to change the way you think about value. You have to stop pricing assets in a vacuum and start pricing them against the new, higher cost of risk-free capital. For a decade, the main question was, will this go up? The new, more important question is, does this asset's return justify its risk compared to what I can now get from a safe alternative? Today, a 10-year U.S. Treasury bond offers a yield over 4%. That figure is your new baseline. It is the risk-free rate that every other investment must convincingly beat. This is the simple test that will drive the everything repricing. Consider a high-flying tech stock with no dividend trading at 50 times earnings. In a zero-rate world, that speculation was defensible. But now you must ask, does its potential growth truly justify its risk compared to a guaranteed 4%? After taxes and inflation, suddenly its valuation looks fragile. That is the repricing. The same logic applies to real estate. An investment property that looked great with a 3% mortgage may be unprofitable at 7%. The price of that property must eventually adjust to a level where its rental income provides a real return above the new cost of financing. This compared to what test is your new valuation framework. It forces a shift away from speculative promises toward assets with tangible, defensible value. This means a focus on quality, businesses with strong balance sheets, low debt, and durable cash flows. It means favoring high-grade debt over junk bonds whose yields no longer compensate for their default risk. The great repricing will punish speculation and reward prudence. The winners won't be those who guess the market's next move, but those who recognize the laws of financial gravity have been rewritten. This is the single most important shift for your wealth over the next decade. To help you identify the assets built for this new reality, I've created a guide, the Quality Asset Playbook. It explains how to apply the compared to what test to your own portfolio and find the hidden risks. Download it for free at the link below. This isn't about timing the market. It's about aligning your portfolio with reality. For years, investors watched the horizon for a cyclical recession. They were looking in the wrong direction. The danger isn't a passing storm. It's a tectonic shift happening right under our feet. The bond market is sending a clear message. A fundamental repricing of everything is underway. The era of free money is over, and valuations built on that illusion are now a liability. Complacency is at a peak, just as the financial plumbing is under the most stress in a generation. This won't be a single event. It will be a relentless grind, a slow, painful adjustment to a world where capital has a cost and value must be proven, not just promised. The market is sending its final, quiet warning. The question isn't whether the repricing is coming, it's whether you will be ready for it.